How the Big Beautiful Bill impacts your real estate investment strategy. Are you already investing in commercial or residential real estate? The Big Beautiful Bill now has affected how you buy, hold, and sell real estate deals. This is the video you want to watch to help craft your own real estate strategy. Do you want to boost cash flow and reduce your tax liability? Well, the Big Beautiful Bill has now shifted the game. The rules have changed. It's important that you know what the rules are so you can maximize your real estate. The new bill could be the biggest opportunity yet for the next 5 years. So in this video, I want to break down what the Big Beautiful Bill is, how it affects your cash flow, your acquisition strategy, and your exit strategy so that you build long-term wealth in real estate investing. All right, so the Big Beautiful Bill passed. What does it mean? Well, 100% bonus depreciation is back. If you're in real estate, then you probably know what that means. But if you're not, or you're not familiar with that term, I want to break it down here. Bonus depreciation does this. It allows you to deduct the entire cost of the short life assets of a property like HVAC, flooring, and site improvements in the first year of ownership. Second, it requires a cost segregation study to break down the eligible components of the improvements that would be allowed for bonus depreciation. Third, it is available for all properties that were placed into service or acquired after January 19th, 2025. Fourth, it's been extended to 2030. So from 2025 to 2030, investors now know that bonus depreciation can be used, 100% of it, in the first year of ownership, and gives real estate investors certainty now that we can develop a tax strategy around it. Who is this most useful for? Well, all real estate owners it's useful for, but especially for value-add investors, rehabbers, new developers. These are the properties you can maximize the most amount of depreciation through because of all the improvements or because of the breakdown of the costs of building these properties. These are the types of investors who will benefit the most. So what's the bottom line for a real estate investor? Well, it front loads the tax savings up front and increases the cash-on-cash returns until you run out of that depreciation. So cost segregation studies, now they're a no-brainer. A cost segregation study separates your building into components with shorter tax lives. With bonus depreciation back, you can typically write off 20 to 50% of the total cost of the property that you acquired. So if you bought $1 million property, you could possibly, in some categories of real estate like self-storage or mobile home parks, depreciate up to 50% of that total acquisition price, giving you $500,000 of tax losses in the first year of ownership. These losses are ideal for real estate investors that have large passive incomes or cash flows coming into them year over year. Also, these are ideal for real estate investors selling assets where they're going to have a large capital gain. These losses can offset capital gains from real estate sales. Also, they're ideal for real estate professionals. If you or your spouse has real estate professional status, meaning not a realtor, but qualifying for the IRS's 750-hour rule, then you'll be able to use these passive losses to offset earned income or portfolio income, meaning interest income from bonds or loans that you give to people, or stock dividends. It's a very powerful tool for real estate professionals. Also, a big shift in the bill is the Section 179 expensing. The Section 179 limit has now been increased to $2.5 million from $1.2 million. What is Section 179 expensing? Well, the definition is it allows real estate investors and businesses to deduct the full purchase price of qualifying property, such as equipment, vehicles, and certain building improvements up to a limit in the year that it was placed in service. This accelerates depreciation and again reduces taxes income, boosting cash flow in the year of service. Section 179 applies to office and tenant improvement buildouts, short-term rental property upgrades, fixtures, furnishings, business equipment, vehicles, anything needed for the use or operation of a property. Unlike depreciation, Section 179 allows for immediate deduction. There is no depreciation schedule. The cost of these improvements or this equipment can be deducted immediately. So what do you do after you've depreciated all these assets? Well, your 1031 exchange strategy just got an upgrade. After you've fully depreciated the property that you're acquiring and you're ready to sell it, you can 1031 exchange into the next asset that you would like to purchase and defer taxes again. The kicker with this strategy is when you 1031 exchange a property, Any property that you buy above the price of the property you sold, you can now bonus depreciate that additional amount of property or improvements, which allows for more bonus depreciation and tax deferral. Ultimately, this keeps both capital gains and recapture of depreciation tax deferred. You're now pushing it down the road and you're still acquiring larger and larger asset bases. These strategies are ideal for timing. Now that you've had a property that you've maximized the value, where you don't want to put any more money into deferred maintenance and you'd like more of a passive or more stabilized property, selling off these other properties and moving them into an improved investment property is ideal because there's these strategies to defer the tax. It's not just deferral anymore, it's defer and deduct. That is an outstanding strategy. And now we have certainty as real estate investors from 2025 to 2030 that we can utilize these strategies. So remember, real estate is a cash flow and capital gains game, and it's a timing game. So now we have some certainty in that we can utilize timing to our advantage. This is where we focus on strategy. With all this front-loaded depreciation, your properties will be or should be cash flowing, and now you can defer the tax and use these losses to carry forward. If you don't use them, you don't lose them. Remember, depreciation is a paper loss, a phantom loss. It's not a real loss. So you can still be generating cash flow and collecting capital gains and not paying the tax, deferring it, but yet it's a paper loss. And on the tax return, it shows that you're losing money, but there's real cash in your pocket. One caveat to understand is you will have to pay tax. This is not a tax-free strategy. When you do finally sell and cash out of your properties, when you bonus depreciate any of your assets, now the recapture on that depreciation, the total depreciation that you used during the life of ownership of that property is taxed at ordinary income tax rates. You're in the highest tax bracket, that's 37% plus. So it's critical that you use these strategies. And if that tax rate is going to be disadvantageous to you, then I would suggest looking at a 1031 exchange that would allow you to defer paying that tax down the road. Now's the window. So buy real estate, utilize bonus depreciation, look at the 1031 tax strategy, and plan effectively for your exits. This is the time to do that in the next 5 years. Now that you're clear on how the big, beautiful bill affects your real estate tax strategy, check out the next video about becoming a real estate professional. So now that you can use these tax losses to offset earned or ordinary income. It is the best strategy out there to maximize tax advantages of real estate. Check it out.